Before we get into the detail of variance analysis then, a little bit of background as to why Chapter 1b is here as home study. Those of you who are using your study text will notice that everything to do with variances is included in Chapter 12. We also have another chapter in these course notes called Chapter 12 Further Variance Analysis. That material in Chapter 12 of the course notes is the material which is new to F5. It's the material then which is specifically in the syllabus and therefore deemed to be important for your F5 exam. We made the decision then to put the assumed knowledge then for variances into the course notes and early on into them so that you could make sure you were up to speed with them, because often it might have been some time since you studied F2 or whatever gave you an exemption for that knowledge, and yet this assumed knowledge is absolutely critical for answering questions in your F5 exam. Because this was introduced as assumed knowledge then from January 2013, you'll see that we've got lots of example past paper questions here without a syllabus outcome next to them. That's because prior to this they were included in the syllabus. What we're going to be covering then in this preparation session is a revision of the basic variances. So remembering then about should cost and did cost and how to calculate those cost and sales variances. Also then important is interpretation and investigation. So what do the variances actually mean? It's all very well and good being able to calculate them, but we need to understand what it is that they mean for the company.
Now remember, in our variance terminology, if we calculate a variance and it's better than we expected, that is known as a favourable variance. So whenever you calculate a variance that's favourable, you need to put this F in brackets at the end of it. If it's worse than expected, that is known as adverse, and we indicate that with an A in brackets after it. If you miss off the signage, you will miss some of the marks available for those calculations. Now in section 2 we have an operating statement pro forma. This is under marginal costing, so hence we start with budgeted contribution. Okay, we then bring in our selling variances before we bring in all of our cost variances to get to an actual contribution, and then we bring in those fixed overheads. We want to deduct the actual fixed overheads from our actual contribution to arrive at profit. So the actual overheads come over into this column here, but we also want to understand how well we've performed in terms of our variances. So we will capture the budget and the expenditure variance to get to that overall actual overhead. Now section 3 gives you the detail behind each of those variances in case you can't remember. So every variance we look at, we should always be looking at a should and did. It's important not to shortcut the variances, always write them out in full. So for materials price variance, actual purchases, if you just do a should cost and did cost, it's very easy to forget what it is you're looking at that should and did cost. Now remember, whilst there's loads of variances here, essentially these first two are repeated throughout. They're virtually identical for your labour variances, your rate and efficiency, we call them then, rather than price and usage, and your variable overhead, your expenditure and efficiency. We're just changing what we're looking at from maybe kilos in materials to hours in labour. So essentially for those 6, we've really got 2 pro formas you need to learn. Your labour variance with idle time here is the standard one, assuming that we haven't budgeted for any idle time. So we're looking at the difference in hours worked and hours paid. Remaining variances then over the page, you've got your fixed overhead variances. Now under marginal costing, we only calculate one, and that is just the expenditure variance. Okay. With absorption costing, however, we have more than that. We have the expenditure and the volume, and they give us our over or under absorption. And the volume we can break down into efficiency and capacity. Lastly then are our sales variance. So we have our price and we have our volume. Now with the volume, people often want to value that at the selling price. That is not what we value it at. We value it at contribution. If we're looking at marginal costing, we do it at profit if we're looking at absorption costing. So take some time to work through these pro formas now. Make sure you're happy with them, comfortable with them. And when you are, then you can resume the recording and we'll have a look at example 1. Let's have a look at example 1. If we have a look at the requirements, first of all, in A, we've got to reconcile the budgeted contribution. So here we're using marginal costing to the actual profit. For 1 week, tells you there marginal costing. Obviously, if it hadn't, we know that because we're starting with contribution. We then got to prove the actual profit. And then we've got to suggest possible causes for those variances that we've identified. So let's have a look at the scenario. We've got Brenda and Eddie running an Italian restaurant which sells pasta dishes. Each use similar ingredients and take the same amount of time to prepare. So you've got a standard costing system. You've got there the cost card for each of your meals, the selling price and the profit on each meal. We're then told about our overheads. They are absorbed on the assumption that we normally sell 100 pasta meals per day over the year. We're open for 300 days in a year and we have a 6-day week. Okay, we then get some actual data. So this piece up here is our standard data. We then here have our actuals. And in terms of that actual data, 630 meals bought. Got the revenue. Ingredients, notice here we've got difference bought and used. Hours paid. We then got 10 hours lost due to late delivery of ingredients. And then our variable and fixed overheads. Okay, so let's have a look at doing part A first of all. So if we have a look at an approach first of all for a question or a requirement such as part A. First of all, draw up your pro forma for your operating statement. That way you can just drop in the items into it as you go, leave space for anything that you've missed that you need to come back to. Won't forget about it in that way. Calculate your standard contribution per unit first, and your budgeted contribution you can then do, so the top line of your pro forma. Then do your cost variances. Now I suggest doing those first, basically because people are most comfortable with the materials variance, so it's a good place to start. And then lastly, do your sales variances. So, got your pro forma drawn up. Let's start then with our contribution working. Now the contribution is selling price less all our variable costs, so we can drop those in from the information that we were given in the question. Now we get contribution of £3.85 a unit. Now what we then want to do is calculate our total budgeted contribution, and we've got £3.85 for all of the meals we're expecting to sell. And remember, we have 100 meals expected each day, and we've got a 6-day week. So multiply those two by 3.85, we get to our budgeted contribution of 2310. We then look at our materials Price variance, remember, is actual purchases should cost and actual purchases did cost. So the actual purchases, your 260 kilos, you want to get from the actual information, the should cost from the standard information. Make sure you pick up the rate per kilo, not the rate per meal. Compare that with what we actually spent, and you can see here that we spent 10 less than we were expecting to, so that is a favourable variance. Have a look at the usage variance. Remember, that is based on our actual production. So our actual production was 630 meals. They should use 400 grams each. What we actually used though is 240 kilos. So less again here. So a favourable variance of 12 kilos. Now obviously we can't put 12 kilos in our statement. We need to bring in a value in dollars. So we valued it at the standard rate of a kilo, which is 150. Having calculated those two, you can drop those into the appropriate place in your pro forma. You save it all up to do at the end. You can find you just drop things in wrong columns. So let's have a look at our labour variances next. First of all, the rate variance, which is based on our actual hours paid. We actually paid for 300 hours of labour, and we are supposed to pay $4 an hour. So we should have spent 1,200. We actually spent $13.50 on our labour bill, so that is an adverse variance of 150. The labour efficiency. Have a look at labour efficiency. That's based on our actual production, and what we bring in here is how long it should take us. So our actual production should take, and when we're looking at the did take, we're actually bringing in our hours worked. Now we were told here that we paid for 300 hours, but we had 10 hours lost due to late delivery of ingredients. So the 300 less the 10 is how we get to the 290. So we used 25 hours less than expected. We want to value that at the rate per hour of $4. So that gives us an overall variance of 100 favourable. Now there's one other labour variance we need to be aware of, and that is our idle time variance. Now all we're doing here is comparing the hours worked with the hours we paid for. So we had a difference here of 10 hours, the 300 less the 290. Again, we value them at the standard rate per hour, so we get an idle time variance of $40. So variable overheads then. If we look first of all at our expenditure variance, we base that on our hours worked. Now people often don't remember what it is they're bringing in here, hours worked or hours paid. A good way to remember this is to think of VW. Okay, so Volkswagen, VW, variable overheads are based on hours worked. So our hours worked were 290. Now when you're bringing in the should cost, make sure you bring in the rate per variable overhead hour, not the labour. So in this instance we're looking at $1 an hour. We actually spent more, we spent 35 more, so that is an adverse variance. So variable overhead efficiency then, well, this is based on our actual production, and this formulae to start with in terms of the hours is exactly the same as your labour efficiency variance. So you can always shortcut this here and say as labour hours 25 favourable, and then just bring in the valuation at the variable overhead rate per hour. Okay, so all we've got left in terms of our cost variances are our fixed overheads, and because we're doing this under marginal costing, we only want our expenditure variance. Now, because we're doing this under marginal costing, what we want is just our expenditure variance. So what we're comparing here is the budgeted overheads with the actual. So should and did, again, here what we should have spent compared with what we did spend. Now we have no difference here, so we have a nil overhead variance. So that's our cost variances. Let's have a look then at our sales variances. So first of all, our price variance, so based on the actual units that we sold, how much should we have got for them compared with how much we did? Now here, we actually got more than we expected, so favourable variance here of 121.50. Be careful when you start on your sales variances. When you've done loads of cost variances, it's very easy then to just carry on in the same sort of manner, and therefore here putting the 121.50 in brackets and assuming it's adverse. But remember, here we are talking about income. Lastly then, our volume variance. What we're doing here is comparing our actual and our budgeted sales. So we sold 30 meals more than expected, which is good news. And then remember, we value those at the contribution that we get from a meal. So that's all our variances calculated. We can then drop that all into our pro forma. When we do that, what we find is we get an actual profit of 17.25. Do you know what? I think you might save it. Now part B asked us to prove our actual profit. So we just need to do a mini P&L, bringing in our actual sales and all of our actual costs. Now notice here for your materials, the 380 represents the 260 kilos that we bought, but we only used 240. So we've got here a difference of 20 kilos that we didn't use that will actually get used next time. Now the standard cost of those was 150. So 20 times 150 equals 30, and that is what we're therefore reducing the 380 by. We only want to bring in the material we've actually used. Okay, we then got all of our other costs as we were given, and that gives us 1725, and as you can see, that agrees with the profit that we got on our operating statement. So 1725, 1725. Now, when this has been examined, you've been asked to reconcile using your operating statement, but there have also been marks going for this actual profit proof. So if you've got time to spend a couple of minutes to draw this up, worth doing, even if it doesn't explicitly state that that is what it wants in the question. So pause your presentation for a moment to have a think about the causes for the various variances that we've identified in our operating statement here, and then resume to have a look at some of the possible causes that you could have come up with. So here are some of the possible suggestions you could have made for the various variances that we have here. So we had a favourable price variance. Just some of the things there that you could have mentioned for why that price was better than anticipated. Favourable usage variance. We had adverse labour and favourable efficiency. Idle time, we were told that your variable overheads there as well. Now, as well as trying to think about these things in isolation, try and think about some of the impacts that one variance can have on another. So, for example, under our labour efficiency variance here, one of the reasons could be better quality of materials, therefore less rework. Now, that would be likely if we'd had an adverse price variance, so we'd bought more, but actually we had favourable, so we thought they might have been cheaper quality goods. So that might not therefore be a relevant reason when we look at the two together, but quite often there are some linkages which you can see like these, which help give your answer an added kind of extra bit of weight. Now, section 3.6 mentions some of the differences between absorption and marginal costing, as we've talked about. So the fixed overheads, we get additional variances. We get the volume variance, and that can be broken down into capacity and efficiency. The sales volume variance, we value at profit, not contribution. And then lastly, that operating statement, we'll start with budgeted profit and then reconcile that to our actual profit. So let's have a look at these differences in example 2. We've got to analyse the fixed overhead variances in detail and then prepare an operating statement using absorption costing principles. So the fixed overhead volume variance, we're comparing our expected units with our actual units, and we value those at our overhead absorption rate. Now note here what we're bringing in is meals or units, so your overhead absorption rate is also based on units. Don't bring in the 1 per hour by mistake. So it made more meals than expected, so despite this being a cost variance, it's good news, it's a favourable variance. Now we can break that down into our efficiency and capacity variances. Now efficiency variance, again, will be familiar. We've got our 25 favourable labour hours that we've seen already for both the labour and the variable overhead efficiency. Fixed overhead efficiency exactly the same. The only difference is that we value it at the fixed overhead absorption rates per hour. So this time we have a favourable variance of 62.50. So last one then is capacity, and what we're doing here is comparing our budgeted hours with our actual hours. So the budgeted hours, we were selling 100 meals a day, 6 days in a week, and we expected each meal to take us half an hour. Now they didn't give you the budgeted hours in total. You've got to look for that information and find that. So be prepared to have to dig around rather than them just giving you everything in the question without any calculations at all. Note here again, the actual hours is based upon your hours worked. Okay, we're looking at the capacity. How many hours did we get out of that factory? It's only those hours we're working for. So we've got a difference of 10 hours. We value that at the overhead absorption rate per hour. So $25 is the variance. And this variance is adverse because we got less hours from our factory than we'd expected to. Now, if we were to reconcile all of that, we can see here now our capacity variance here is 25 adverse. Our efficiency we calculated as being 62.50 favourable. So if I take away the 25 adverse from that, that gives me a rate of 37.50, and that should be the amount of our volume variance. So if we just check back to that, we can see there is our 37.50 favourable volume variance. Now remember your expenditure variance. Our expenditure variance was 0. So our total overhead variance under absorption costing would be 37.50. Now just to prove that for you, let's have a look at how we get to 37.50. What we're doing is comparing our overhead absorbed with the overhead that we actually spent, and the difference there is an overhead absorption of 37.50. Now they're the difference in our overhead variances. There was another difference that we needed to deal with, and that is just our sales volume variance. So the number of units, 30, exactly the same as before, but this time we value it at standard profit. So that gets us to $78 favourable. So if we drop this and our new overhead variances into our operating statement, everything else remains the same. We can see here that we get to our actual profit still, 17.25, just about read the 25 there. So the 78 coming in as a favourable, and you can see now with our fixed overhead items, just bring those in as another cost variance. Now if you've calculated your volume, your capacity and your efficiency, obviously don't bring them all three in because we'll be double counting. Depending on the requirement in the question, you might just need to bring in volume. You might be on the safe side, want to bring in the capacity and the efficiency as well, just to demonstrate the full detail of the variances there.
As well as the calculation then, we also need to make sure that we can interpret any variances. The first thing to remember about variance interpretation then is that we're only going to be appraising people on things which are within their control. So if then we decide to change suppliers and buy a cheaper material, that's going to be an example of controllable expenditure. However, a rise in the world price of a commodity is beyond the control of the company, and so that's not going to fall within the remit of the purchasing manager. It's not going to be their influence which is going to have affected that price. We can also end up then with a variance because we had a poor standard, so perhaps we were using an ideal standard, or we failed to collect information about what the price of materials was likely to be. And you'll see more then on those split outs in chapter 12. Interdependence then is what is absolutely important here when we're thinking about variances. So this is the impact then that one variance can have on another. So one decision then can have on other variances. If we think back then to example 1 with Brenda and Eddie's Italian restaurant, we can remember then that the causes for the variance identified are literally interdependent. So hiring that higher grade labour, that better quality chef, resulted in more units being sold for a higher price, and also they were using making them quicker and utilising cheaper ingredients. So interactions then. It's very important that if you're discussing any interdependencies or the explanation of variances, that you try to relate it back to the scenario. On the next page then, we have a table which outlines some of the possible causes of favourable variances and of adverse variances. You shouldn't just learn this table then, but you can use it for inspiration and perhaps to help you answer questions, and it can provide then a framework for answering a question. But remember, as I said, the application back to the scenario is absolutely key. Quite often then people get into the mindset of thinking that a favourable variance is always going to be good news and an adverse variance then is always going to be bad news for a business. However, that's not the case. For example then, a favourable variance, so you might have a favourable material price variance because you've bought some cheaper materials, but that could be coupled with adverse usage, so you end up using more of the material. It could also result then in adverse labour efficiency, so labour perhaps having to use more of these cheaper materials but also having to redo things because the materials they are using are substandard. That could also result in adverse sales variances, both in terms of price, you might have to sell it for less money if it's lower quality, and also in terms of volume, so you might end up selling fewer units. So sometimes it might seem like a good idea to buy cheaper inputs, but the knock-on implications then could be quite large, and overall the decision could be poor news for the company. Sometimes then when an adverse variance might be good news for a business, well, if we think about having an adverse material price variance, we might end up with the opposite of the situation we've outlined above. So we might sell more units at a higher price, labour might be able to produce them quicker, and we might end up using less of the materials. So sometimes, depending on the production process, buying a more expensive input could be good news for the company. Also, we might see that if we've got an adverse labour rate variance, that could also have positive implications overall. So we could end up with favourable usage of raw materials. We could also end up with favourable labour efficiency, so higher skill. More expensive staff having a higher skill could be able to use their time more efficiently, and that could result in a favourable sales price and or volume. So it's important then that you think about, again, the interdependence and the interrelationship between your variances. The calculation then of variances is still very important for your F5 exam, despite now being assumed knowledge in the syllabus. So it's important then that you're happy that you can calculate these basic variances and interpret them. We should also then make sure that we're happy with investigating those variances. You may wish to work through some of the questions highlighted at the start of the chapter if you feel that your knowledge of these basic variances is a little bit rusty.